Hey there, curious minds. Welcome back to the deep dive. We're here to crack open another one of those topics that might seem a bit dense at first glance.
That's right.
Today, we are plunging deep into the world of cost accounting. Now, I know you might be thinking numbers, spreadsheets, maybe a bit dry,
Uh-huh.
but honestly, stick with us because this isn't just about crunching figures. It's really the secret language businesses use to understand themselves, to make those big strategic calls, and frankly, to find ways to run better.
And that's absolutely our mission today. Cost accounting, it's less about the raw math and much more about turning that financial data into insights you can actually use.
Mm.
Actionable intelligence, really.
Yeah.
So we're going to untangle the core ideas, help you really grasp how companies track costs, how they classify them, and how they use that information to optimize, well, pretty much everything. From setting the price for your favorite coffee to guiding the long-term strategy of a huge corporation. By the time we're done here, you'll see why getting these concepts is like a direct shortcut to being genuinely well-informed about the financial pulse of almost any organization out there.
And we've lined up some fantastic resources. We're going to shed light on everything from those really obvious direct costs you can almost point to, down to the more subtle indirect ones. We'll look at how different products end up with their specific price tags, and even get into the tricky business of handling multiple products that pop out from the same production process.
Yeah, that's always an interesting one.
Okay, then let's start peeling back these layers. Let's dive in. #tag the foundation. What are costs and cost objects? So let's start right at the beginning, the absolute foundation here. When we talk about cost objects, what exactly are we trying to pin down? Is it just the final thing you sell, or is it broader than that?
That's a perfect place to start because, yeah, it really sets the stage. A cost object is basically anything you want to measure the cost of. It's the specific item or activity or maybe even a segment of the business that managers need cost information about to make good decisions.
Okay.
Think of it as the focus point for your cost tracking.
Yeah.
Without clearly defining what you're measuring, what your cost object is, all the cost data you collect after that is kind of meaningless.
Right.
It lacks direction.
Right, so it gives it context.
Precisely.
Right.
And while a finished product is, a very common cost object, like asking, how much did it cost us to make that specific phone? The idea is actually much wider.
Okay.
So for a car company, a cost object could be an entire product line, maybe all their SUVs versus their sedans. Or it could be a single department, like the marketing department, to see how much they're spending.
Ah, okay.
It could even be a geographic region, like figuring out the profitability of sales in the Northeast versus the Southwest. Or maybe even a specific customer if they're large enough, or a particular service activity like handling returns.
Wow, okay. So it's really flexible.
It's incredibly flexible. And the key insight is this. How you define your cost object determines what kind of insights you can get. It's the lens you use to analyze all that financial data, and it shows you where your resources are really going.
All right, so once you've figured out what you're tracking, the next big step seems to be classifying those costs. Because, like we know, not all expenses get treated the same way in accounting. One of the most fundamental splits is between product costs and period costs. How should we think about those two?
Oh yeah, this distinction is absolutely foundational, and honestly, it's one where people can get a bit tangled up sometimes. So product costs, think of these as all the costs that are directly intrinsically linked to manufacturing a product.
Right.
They're the actual components, the materials, the labor, the factory resources needed to physically create that item. Accounting-wise, these costs start their life as assets. They get recorded as part of your inventory on the balance sheet.
Right. Inventory is an asset.
Exactly. They sort of stick with the product, like an invisible price tag, as it moves through production and sits in the warehouse. It's only when that product is actually sold that these costs make the jump from the balance sheet asset to an income statement expense. Specifically, they become part of the cost of goods sold, or COGS.
Okay, so they follow the product's journey.
Perfectly put. And these product costs usually break down into three main pieces. First, direct materials, the raw stuff. Second, direct labor, the hands-on work. And third, manufacturing overhead, all the other factory costs needed. If you want a visual, imagine raw materials and direct labor flowing into this account called work-in-process inventory. That's where the magic happens, the transformation. Once the item's finished, the costs bundle up and move to finished goods inventory waiting to be sold.
Gotcha.
Then, bam, sale happens, and those costs finally become cost of goods sold on the income statement, hitting your profit. Now, within these product costs, accountants often use two helpful groupings. Prime costs are direct labor plus direct material, basically the core traceable stuff. And conversion costs are direct labor plus manufacturing overhead, representing the cost to convert those raw materials into a finished product. These groupings just help managers analyze different parts of the production cost structure.
Okay. That makes sense for product costs tied directly to making the thing. So then, what about period costs? They sound less about the factory floor and maybe more about, well, just running the business generally.
That's exactly right. If product costs are the engine inside the factory, period costs are more like the administration and sales machinery outside the factory. These are all your non-manufacturing costs, the expenses you incur to sell your products and just generally run the company's operations.
Okay.
And the key difference is, unlike product costs, these are not attached to inventory. They don't sit on the balance sheet waiting. Instead, they're expensed directly on the income statement in the specific accounting period they occur. They're tied to time, not to product units.
Ah, okay. So they hit the income statement right away.
Immediately. Think about sales commissions. They relate to sales effort in this period. Or the salaries for your administrative staff, the CEO, the finance team. They manage the overall business this period.
Right.
Rent for the corporate headquarters or the sales office, totally separate from the factory rent. All your marketing, your advertising costs. These are all period costs. They're absolutely essential for the business, for generating sales, but they don't get capitalized into the cost of an item sitting in the warehouse.
So this split seems really fundamental for reporting things accurately.
Oh, it's critical. The whole point of a cost accounting system, fundamentally, is designed around a few key goals. First, getting that product cost right for valuing inventory and calculating COGS. Second, determining income accurately, figuring out true profitability. And third, measuring efficiency, often by comparing actual costs to budgets or standards. So understanding this product versus period cost distinction is vital. It lets a company see the real profitability of selling each item, because it separates the cost of making it from the cost of selling it and running the office. It helps answer, is our product itself expensive to make? Or is our sales team just generating high commissions this month? Two very different things. #tag following the money direct versus indirect costs and overhead.
Okay, building on that, within those product costs, you mentioned direct materials and direct labor. What exactly makes a cost direct? It sounds obvious, but maybe there's more nuance.
No, it's a good question to dig into. The absolute essence of a direct cost is its clear, unambiguous traceability. It's a cost that you can easily and, without spending a ton of money or effort trying to figure it out, trace specifically to one cost object.
Okay, a clear line.
A very clear, straightforward line from the cost itself right to the item or the activity you're measuring. So let's take direct raw materials. These are the actual physical bits and pieces that go right into the product. And it's not just the purchase price. It includes freight in, the shipping cost to get those materials to your factory, net of any discounts you got.
Ah, shipping counts too.
It does, if it's directly for those materials. And we even include a reasonable amount for what's called normal scrap, the little bits of waste that are just unavoidable in the production process.
Okay.
Let's use that Spud Furnishings Inc. example. They make custom couches. The specific, unique fabric or the piece of leather chosen for your particular couch, that's a direct material. You can see it, you can measure it, you know it's just for that one couch. That's direct.
Got it. Very specific.
Exactly. And similarly, direct labor. This is the wages you pay to the employees who are physically hands-on involved in creating the product or performing the service. It's the time they spend actively working on that specific item. Plus, importantly, a reasonable amount for expected downtime directly related to production, like short breaks, setting up a machine for that specific job, maybe some quick central training related to that task.
Okay.
So for Spud Furnishings, the upholsterer, the hours they spend cutting, sewing, assembling your specific couch that's direct labor, their time is explicitly linked to that single identifiable piece of furniture.
So the big takeaway here is that clear one-to-one connection. You can point and say, that person's time went only into making that specific chair.
Precisely. That direct, traceable relationship is what defines it.
Okay. Now for the other side, indirect costs. These always seem a bit fuzzier. Why are they generally harder to trace, and what kinds of things fall under this umbrella?
Yeah, they are definitely more elusive because they lack that direct one-to-one link. Indirect costs are expenses that you just can't easily trace to a single cost object. Instead, they typically benefit multiple products or multiple production processes or different departments all at the same time.
Shared costs, essentially.
Exactly. Because they're shared, they get lumped together into what we call manufacturing overhead. Now, they're absolutely essential for production to even happen, but they support the whole operation, not just one specific unit.
Right.
Think about indirect materials. These are materials used in the factory, but it's just not practical or cost-effective to track them to individual products. For spud furnishings, maybe it's the glue used in small amounts across many couches, or the cleaning supplies for the sewing machines, or sandpaper, general shop rags.
Okay.
They're necessary, but trying to measure exactly how much glue went into one specific couch cushion? Probably not worth the effort. So it's indirect. They help create the environment where all the couches get made.
Okay, that makes sense. What about labor?
Then you have indirect labor. This is the wages for employees who support the manufacturing process overall, but they don't work directly on specific products. At spud furnishings, think about the forklift drivers moving big rolls of fabric around the warehouse, or the maintenance workers keeping all the equipment running.
Ah, okay. Supervisors, too.
Definitely supervisors, quality control inspectors, factory janitors, maybe even the engineers designing process improvements, or the HR staff specifically for the factory.
Yeah.
Their work enables everything, but you can't really measure their time per couch.
Right.
And this raises that core question for companies. How do you fairly assign a portion of these shared supporting costs to each individual product? That's where cost allocation comes in, which we'll get to.
Okay. And are there other types of indirect costs besides materials and labor?
Yes, absolutely. The third category is just other indirect costs. These are all the other miscellaneous factory costs. For spud furnishings, this would include things like depreciation expense on the factory building itself and on the manufacturing machinery, rent if they lease the production warehouse, property taxes on the factory, insurance for the factory, and utilities like electricity and water for the whole plant.
Okay. So basically factory costs that aren't direct materials or direct labor.
That's a great summary. They support the entire production environment.
So just to recap those formulas we mentioned earlier, prime cost equals direct labor plus direct material, the core traceable elements. And conversion cost equals direct labor plus manufacturing overhead, the cost of transforming materials. These just help managers categorize spending quickly, right?
Exactly right. They offer quick perspectives on different aspects of cost. Now, you asked earlier how we handle assigning those tricky indirect costs, that overhead, to specific products. This is where overhead allocation using cost drivers becomes so important.
Right, the allocation piece.
Since you can't trace indirect costs directly, you have to assign them or allocate them to the cost pools or cost objects that benefit from them. And this allocation process hinges on using cost drivers.
Cost drivers. What are those exactly?
A cost driver is basically an activity or a factor that is believed to have a strong cause and effect relationship with why those indirect costs are incurred. It's the thing that makes the overhead cost go up or down.
Okay, like machine hours driving electricity costs.
A perfect example. If running machines uses more electricity, then machine hours is a logical cost driver for allocating electricity costs. These cost drivers, when used for allocation, are often called allocation bases. Now, in what we call traditional costing systems, often all these varied indirect costs, indirect materials, indirect labor, factory rent, utilities, depreciation, they all get dumped into one big cost pool just called overhead.
One giant bucket.
Pretty much. And then this single large pool is allocated out to products using just one, usually volume-based driver, like total direct labor hours for the whole factory or total machine hours. It's simple, but can be a bit crude.
Okay. How does that application actually work then? Is it done after the fact?
Good question. It's actually a two-step process, and step one happens before production starts. In step one, you calculate a predetermined overhead rate. You take your budgeted or estimated total overhead costs for the upcoming period, and you divide that by your estimated total amount of the cost driver for that same period.
So it's based on estimates.
Exactly. It's done beforehand.
Okay.
So let's say Spud Furnishings estimates $1 million in total factory overhead next year, and they expect their upholsterers to work a total of 50,000 direct labor hours. Their predetermined overhead rate would be $1 million divided by 50,000 hours, which equals $20 per direct labor hour. This $20 rate is what they'll use throughout the year.
Okay, so they have the rate. And what's step two?
Step two is applying that overhead as products are actually made. You take the actual amount of the cost driver used by a specific job or product. Say, one particular custom couch took 30 actual direct labor hours, and you multiply that by the predetermined overhead rate from step one.
Ah, okay.
So for that couch, the applied overhead would be 30 actual hours times the $20 per hour rate, which equals $600. That $600 gets added to the direct materials and direct labor costs for that specific couch job.
Got it. So estimate the rate upfront, then apply it based on actual activity?
That's the essence of traditional overhead application. And while this single pool volume-based approach is common, it's worth mentioning again that more advanced methods like activity-based costing use multiple pools and drivers for more accuracy. We'll definitely circle back to that later. #tag costs in motion understanding cost behavior.
Okay, so beyond just classifying costs as direct or indirect, another really critical way to think about them is how they behave, how they react when activity levels change. This feels important for planning and budgeting.
Oh, absolutely vital. Understanding cost behavior, how costs change or don't change as production or sales volume fluctuates, is fundamental for almost all managerial decisions. It impacts pricing, make or buy choices, budgeting, everything.
So what are the main categories here?
Generally speaking, we find that direct materials and direct labor often behave as variable costs. Their total amount tends to change proportionally with production volume. Manufacturing overhead, though, that bucket of indirect costs, is usually a mix. It typically contains both fixed and variable components.
Okay, let's break down variable costs first. What's their key characteristic?
The defining feature of a variable cost is that its total amount changes in direct proportion to changes in the activity level, or cost driver. If you make twice as many couches, your total cost for the fabric, a direct material, will likely double.
Okay, total cost changes.
Yes, but, and this is the crucial part, the variable cost per unit remains constant. If the specific type of wood for one Spud Furnishings chair frame always costs $50, then whether they make one chair or 100 chairs, the total wood cost goes up. But that $50 cost per chair stays the same. Within a reasonable range of activity, this relationship holds true.
Got it. Total varies, per unit is constant. Now the opposite must be fixed costs.
Exactly. Fixed costs in the short term, and this is important, within a relevant range of activity, do not change in total amount when the activity level changes. Think about the monthly rent for the Spud Furnishings factory building.
Right. The landlord doesn't charge more if they make more couches that month.
Precisely. Whether they produce 10 couches or 100 couches, that total rent bill stays the same for the month. But here's the interesting twist with fixed costs. While the total amount is constant, the fixed cost per unit varies inversely with activity. Well, as production goes up, that same total fixed cost gets spread over more units. So the fixed cost allocated to each individual unit goes down. If Spud's rent is $10,000 a month and they make 10 couches, the rent cost per couch is $1,000. But if they ramp up and make 100 couches, the rent cost per couch drops to only $100.
That makes sense. The cost gets diluted over more units.
Exactly. And this is a classic trap, especially in exams or analysis. Be really careful with fixed cost per unit figures. Always try to convert it back to the total fixed cost amount, because that's the figure that stays constant within that relevant range. The per unit figure can be misleading if activity changes.
Good tip. What about the long run? Are fixed costs always fixed?
Not necessarily. Given enough time or a large enough change in activity, almost any cost can become variable. That factory rent is fixed up to the capacity of the current building. But if Spud Furnishings grows significantly and needs to lease a second factory, then suddenly their total rent cost has changed in response to the increased production level. So in the very long run, the distinction can blur.
Okay, that clarifies the variable versus fixed distinction. But you mentioned overhead often has both. What happens when a cost is sort of a hybrid, a bit fixed, a bit variable?
Yep, and that's very common in reality. We call those mixed costs, or sometimes semi-variable costs. These are expenses that have components of both fixed and variable behavior baked into them. There's usually a base, fixed amount that you pay regardless of activity, plus a variable component that fluctuates with usage or production.
Okay, can you give an example?
Absolutely. Let's use Quality Ornaments, Inc., the porcelain figurine maker. We can go through their annual costs and classify them. Direct labor, $3 million. This is directly tied to making each ornament. More ornaments, more labor cost. So clearly variable. Indirect labor, $200,000. The description is key here. It says it includes a base annual contractual amount that sounds fixed and a variable rate amount for hours worked above a contractual threshold. Fixed plus variable equals mixed cost.
Okay, that's a clear mixed one.
Raw materials, $6 million. Like direct labor, consumed per unit, definitely variable. Plant depreciation, $440,000. They use the straight line method, which means it's a constant charge each year regardless of production volume. That makes it fixed. Electricity, $250,000. The description explicitly says it's directly tied to hours of production. So it behaves like a variable cost.
Right, more production hours, higher electricity bill.
Heating, $100,000, described as an annual rate. This implies it's a set cost for the year, probably regardless of how many figurines they make. Sounds fixed. Delivery expenses, $25,000. This is based on a formula per customer order. Since the number of orders varies, this cost varies too. It's variable. Building and equipment maintenance, $10,000. Again, the description tells the story. Include both a fixed contractual amount and a variable rate amount for maintenance performed on Saturdays and holidays, presumably when production is higher or needs extra support. Fixed plus variable, again, means mixed cost.
Wow, okay, so you really have to look at the details of how the cost is incurred.
Absolutely. So for quality ornaments, if we tally it up, total variable costs are $9,275,000. Direct labor plus raw materials plus electricity plus delivery. Total fixed costs are $540,000, depreciation plus heating, and total mixed costs are $210,000, indirect labor plus maintenance. The crucial takeaway is that a single line item on an expense report, like indirect labor, might actually contain multiple cost behaviors. You need to dissect it to understand it properly for planning.
You keep mentioning this term relevant range. We touched on it with fixed costs. Can you elaborate on what exactly that means and why it's so important for understanding cost behavior?
Yes, the relevant range is a really practical and important boundary condition. It's the specific span of activity may be measured in units produced, hours worked, or sales dollars for which the assumptions we're making about cost behavior actually hold true.
Okay, so the range where the rules apply.
Exactly. Within this range, we can confidently assume that our total fixed costs will remain constant, and our variable cost per unit will also remain constant, meaning total variable costs change linearly, proportionally with activity.
And why is staying within that range so critical?
Because once you operate outside that relevant range, those need assumptions often fall apart. For instance, your factory might have a relevant range of producing 500 to 5,000 units per month. Within that range, your factory rent is fixed. But if you try to produce 6,000 units, you might need to rent extra space, causing your fixed rent cost to suddenly jump up. You've exceeded the relevant range.
Ah, okay. So the cost structure can change.
Precisely. Or, going the other way, if production drops below 500 units, maybe you can lay off a supervisor whose salary was previously considered fixed within the normal range. So the cost behavior itself can change outside those boundaries. Graphically, you often see costs depicted as straight lines within the relevant range, but then the lines might curve or jump once you go beyond it. This really highlights a key challenge for managers. They constantly need to assess if their current operations are still within the relevant range for which their cost models were built. And if not, they need to update their assumptions about how costs will behave at these new activity levels. It's not a static thing. It needs periodic review. Hashtag tailor tracking job order versus process costing.
All right, so we've got a handle on different types of costs and how they behave. Now let's shift gears and look at the actual systems companies use to track all these costs and assign them to their products. I mean, surely a company building custom yachts doesn't use the same system as a company churning out identical cans of soup.
You are absolutely right. The method used to accumulate and assign costs to products. The cost accumulation system really depends entirely on the nature of what's being produced and the production environment itself. It's a fundamental choice.
So what are the main options?
There are two primary systems that cover most situations. First, you have job order costing. This system is tailor-made for situations where the cost object is a unique custom order or maybe a specific batch of products where each batch is distinct.
Like a custom couch example.
Exactly like Spud Furnishings. Or think about a construction company building a specific bridge, an advertising agency creating a campaign for one client, or a movie studio producing a single film. Each job is different, so you track the costs specifically for that job.
Okay, unique items. What's the alternative?
The alternative is process costing. This is used in mass production environments where companies produce huge numbers of identical, homogeneous items in continuous flow. Think oil refining, chemical production, flour milling, or that soup canning factory you mentioned.
Right, you can't track each can of soup individually.
Precisely. It would be impossible and pointless. So instead of tracking cost by job, process costing averages the costs over the massive volume of identical units produced during a period. The focus is on the cost of the process for a given time, not the individual unit.
Are there other variations besides these two main ones?
Yes, there are some hybrids and specialized systems. Operations costing kind of blends job and process costing, useful for products that have some common processes but also some customization, like different car models on the same assembly line. Backflush costing is sometimes used in, like, super efficient just-in-time manufacturing settings where work-in-process inventory is minimal, so they simplify the tracking. And lifecycle costing takes a much broader view, looking at costs all the way from R&D and design through manufacturing, marketing, customer service, and even disposal at the end of the product's life.
Wow, okay.
What this variety really shows is how different industries and production philosophies need fundamentally different ways to think about and manage their costs.
Let's zoom in on job order costing first. So if you're building that custom house or maybe assembling a specific aircraft, this is the method. It sounds like it must be incredibly detailed.
It is, by necessity. In job order costing, the individual job, which could be a single unit like a house or a specific batch like 100 custom-printed wedding invitations, is the cost objective. It's perfect for situations with relatively few units, where each unit or batch is unique or easily identifiable.
The job itself is the focus.
Exactly. The core principle is cost objective is the job. All the costs, direct materials, direct labor, and the applied manufacturing overhead are meticulously allocated to that specific job as it moves through the production steps. The entire record-keeping system is built around tracking costs for each individual job.
What kind of records are used for that?
The central document is the job cost record, sometimes called a job cost sheet or a job order. You have one of these for every single job. It acts like a ledger for that job, accumulating all its costs.
Okay. And where does the data come from?
It flows in from various internal source documents. You'll have materials requisitions, which are forms showing the specific raw materials pulled from inventory for that job. You'll have labor time tickets or time cards showing the hours worked by employees on that specific job, along with their pay rates. Overhead gets applied based on the predetermined rate and the amount of the driver used by the job, as we discussed.
So it's all funneling onto that one sheet per job.
Precisely. Because each job is tracked separately, job order systems often only need a few main work-in-process control accounts. It's really best suited for those customized environments: construction, aircraft assembly, printing shops, architectural firms, repair shops, and yes, custom furniture makers. A new record starts fresh for every new job. If you visualize the flow, raw materials are requested for Job 101. Their cost moves from raw materials inventory to the work-in-process account, specifically tagged to Job 101's cost sheet. Same for direct labor for Job 101. Manufacturing overhead is applied to Job 101 based on its usage of the cost driver, say labor hours. So WIP contains the running total cost for Job 101. Once Job 101 is finished, its total accumulated cost moves from WIP inventory to finished goods inventory. Then, when Job 101 is sold, its cost moves from finished goods to cost of goods sold. It's a very clear, traceable path for each unique job.
Okay, now let's go up to the other extreme. Mass production, like thousands of identical bottles of soda. You can't track each bottle. How does process costing manage that? It must involve averaging, right?
Exactly. Averaging is the key concept in process costing. It's designed for that continuous flow production where you have large numbers of homogeneous, identical items moving through a sequence of departments or processes. Think mixing, then bottling, then labeling.
Okay.
Instead of tracking costs by job, process costing averages the costs incurred in each department over the units processed during a specific period, usually a month. The focus shifts from the job to the process or department.
So how does that work mechanically? What are the steps?
There are generally 5 core steps involved in process costing. 1. Summarize the flow of physical units through the department. How many came in, how many went out, how many are left. 2. Calculate the department's output in terms of equivalent units. This is that key concept for handling partially completed units. 3. Accumulate the total costs incurred by or assigned to the department during the period. 4. Calculate the average cost per equivalent unit for each cost category, like materials and conversion costs. 5. Assign these average costs to the units that were completed and transferred out, and to the units remaining in the department's ending work-in-process inventory.
Okay, that sounds systematic. You mentioned a production report.
Yes, the production report is the central document in process costing for each department. It summarizes both the flow of physical units and the costs for the period. It tracks things like units in beginning inventory, units started or transferred in, units completed and transferred out, and units in ending inventory. A fundamental principle here is balancing. For unit accounting, the total physical units you need to account for, beginning WIP plus units started in, must equal the total units you do account for, units completed out plus ending WIP. Let's say a department starts with 5,000 units and 20,000 more are transferred in. That's 25,000 units charged. If 15,000 are completed and transferred out and 10,000 are left in ending WIP, you've accounted for all 25,000. Perfect balance.
Okay, physical units balance. What about costs?
Same principle applies to cost accounting. The total cost charged to the department, costs in beginning WIP plus costs added during the period, must equal the total cost accounted for, cost of units transferred out plus cost remaining in ending WIP. If beginning WIP had $12,000 in costs and $85,000 were added during the period, total costs charged are $97,000. If the cost transferred out was $60,000 and ending WIP cost is $37,000, you've accounted for the full $97,000. This balancing is absolutely critical for accuracy.
That balancing makes sense. But let's go back to equivalent units. That still feels like the trickiest part. How do you actually quantify work done on half-finished goods?
You've nailed the conceptual core of process costing. Since you have units still in process at the end of a period, they aren't fully complete. You can't just assign them the full cost of a finished unit. That's where equivalent units come into play.
Okay.
An equivalent unit basically represents the amount of work done during a period, expressed in terms of fully completed units. It measures the quantity of direct materials, or direct labor or conversion costs, labor plus overhead, needed to produce one complete unit. It's a way to standardize partially completed work.
Can you give a simple example?
Sure. Imagine Company X has 10,000 physical units in ending work in process. Let's say all direct materials are added right at the beginning of the process. So for materials, those 10,000 units are 100% complete. That means you have 10,000 equivalent units for direct materials.
Okay, simple enough if it's all added at once.
Right. But now let's say direct labor and overhead, conversion costs, are added evenly throughout the process. And suppose those 10,000 units are, on average, only 75% complete with respect to conversion. Then for conversion costs, you only have 7,500 equivalent units. 10,000 physical units, 75% completion.
Ah, okay, so you calculate it separately for different cost components based on how complete they are.
Exactly. You're converting that partially done work into its whole unit equivalent, so you can spread the costs accurately. And a key point to always remember, the number of physical units flowing through will almost always be different from the number of equivalent units calculated because of these partially completed units in beginning and ending inventory.
Okay. Now, I understand there are different ways to calculate these equivalent units, like FIFO and weighted average. How do they differ?
Yes, those are the two main methods, and the choice affects how you handle the costs tied to the units that were already in process at the start of the period, beginning WIP. Let's start with the FIFO method, first in, first out. FIFO assumes that the units that were in beginning WIP are the first ones to be completed and transferred out during the current period. So, when calculating equivalent units under FIFO, you focus only on the work done during the current period.
Only current period work.
That's right. The calculation has three parts. One, the work needed to finish the units that were in beginning WIP. For example, if they were 60% done, you calculate the work for the remaining 40%. Two, the units that were both started A&D completed entirely within the current period, calculated as total units completed minus the units from beginning WIP. Three, the work done on the units that are still partially complete and ending WIP. For costing, FIFO keeps beginning inventory costs separate and uses only the costs incurred in the current period to calculate the cost per equivalent unit for this period's work.
Okay, that sounds quite precise. What about weighted average?
The weighted average method is generally simpler. It doesn't distinguish between units from beginning WIP and units started this period. It effectively blends them together. It calculates equivalent units based on only two components. One, all units completed and transferred out during the period, treated as 100% complete regardless of when they were started. Two, the work done on units partially complete in ending WIP. And for costing, weighted average lives up to its name. It averages the costs from beginning WIP with the costs incurred during the current period. So it uses the total costs, beginning WIP costs plus current costs, divided by the total equivalent units, calculated using the weighted average method, to get a single average cost per equivalent unit.
Okay, let's try that example you mentioned earlier to make it concrete. Beginning WIP was 100 units, 25% complete for conversion costs. 600 units were completed total. Ending WIP was 200 units, 40% complete for conversion.
Perfect. Let's calculate equivalent units for conversion costs using both methods. FIFO equivalent units, conversion. 1. Work to complete beginning WIP. 100 units needed 75% more work. 100, 0.75 equals 75 ES. 2. Units started and completed this period. Total completed 600. Beginning WIP, sure, some 500 units started and completed equals 500 EOS. 3. Work in ending WIP. 200 units, 40% complete equals 80 EUs. 3, work and ending WIP. Total FIFO E is 75 plus 500 plus 80 equals 655 equivalent units.
Okay, 655 for FIFO, now weighted average.
Weighted average equivalent units. Conversion 1, units completed and transferred out. All 600 units are counted as 600 EUs. 2, work and ending WIP. 200 units, 40% complete equals 80 EUs. 2, work and ending WIP. Total weighted average EUS was 600 plus 80 equals 680 equivalent units.
So weighted average gives a higher number of equivalent units in this case because it includes the completion of beginning inventory units within the units completed figure.
Exactly. FIFO isolates current period effort, while weighted average blends beginning inventory work with current period work. This difference directly impacts the cost per equivalent unit calculation and, consequently, the valuation of inventory and cost of goods sold. It's a key distinction in process costing.
What happens when things inevitably go wrong in production? Units get spoiled, they break, they don't meet quality standards. How does cost accounting handle that imperfection? Does it mess up all the calculations?
That's a very practical question. Production isn't always perfect. Spoilage is a reality. Cost accounting has specific ways to deal with it, and it doesn't necessarily throw everything off. Generally, the cost of spoilage gets accounted for somewhat automatically, because the number of good equivalent units produced will be less than the total units worked on. But we need to distinguish between two types of spoilage.
Okay, what are the types?
We have normal spoilage and abnormal spoilage. Normal spoilage is the spoilage that's expected to occur even under efficient operating conditions. It's considered an inherent, unavoidable part of the production process for that specific product or technology.
Like some percentage is always expected to fail.
Exactly. Maybe 1% of glass bottles break during filling, no matter how careful you are. The key accounting treatment here is that the cost of normal spoilage is absorbed by the good units produced. It's treated as a necessary cost of getting the good units. How? The total production costs are simply spread over fewer good equivalent units, which automatically increases the cost per good unit slightly. So normal spoilage cost gets capitalized into the inventory cost of the good units.
Okay, so it's built into the cost of the good ones. What about abnormal spoilage?
Abnormal spoilage is spoilage that is not expected to occur under normal, efficient operations. It's usually due to things like machine malfunctions, unusual operator errors, or perhaps defective materials that shouldn't have been used. It's considered largely preventable.
So unexpected and avoidable.
Generally, yes. And because of that, its cost is treated differently. The cost of abnormal spoilage is not absorbed by the good units. Instead, it's identified separately and expensed on the income statement in the period it occurs, usually as a loss from abnormal spoilage or similar line item. It's treated as a period expense, a hit to profitability for that period, rather than being part of the product's inventory cost.
Okay, let's see that in action. You mentioned Fresh Baked Company making fruit pies. Let's walk through their numbers.
Right. Fresh Baked Company had costs in April, $45,000 for pie ingredients, $24,000 for baking labor, $11,000 for plant production overhead. They also identified $400 as normal spoilage cost and $200 as abnormal spoilage cost.
Yeah.
They produced 20,000 good pies.
Okay, so how do we find the cost per good pie?
First, we calculate the total cost that should be attached to the good inventory. This includes the direct costs, the overhead, and the normal spoilage. So $45,000 ingredients plus $24,000 labor plus $11,000 overhead plus $400 normal spoilage gives us a total of $80,400 in inventoriable costs.
Right, the normal spoilage gets included.
Exactly. Now, we divide that total inventory cost by the number of good pies produced. $80,420,000 good pies equals $4.02 per pie. That's the cost assigned to each pie in inventory.
Okay, $4.02 per good pie. What about the abnormal spoilage and other expenses?
Those are treated as period expenses, hitting the income statement directly, not inventory. So Fresh Baked had $500 in sales and marketing, $1,200 in general and administrative costs, and that $200 in abnormal spoilage. The total period expenses for April would be $500 plus $1,200 plus $200 on $1,900.
Got it. So the abnormal spoilage is treated like G&A or marketing expense, hitting profit now, not later when the pie is sold.
Precisely. It highlights inefficiency separately, rather than hiding it in the cost of good products. It's a really important distinction for managers evaluating operational performance. #tag the big picture cost of goods manufactured and sold.
Okay, we've really dissected costs, what they are, how they behave, how we track them using job order or process costing, even how to handle spoilage. Now let's zoom out. How does all this detailed internal information come together in the main financial statements that investors and outsiders see?
Right. This is where the internal bookkeeping connects to the external reporting. For manufacturing companies, two key statements bridge this gap. the cost of goods manufactured, COGM statement, and the cost of goods sold, COGS statement. These essentially summarize all that production activity we've been talking about. They can be separate schedules or built right into the income statement notes.
Let's start with the cost of goods manufactured, COGM statement. What's its main job?
The COGM statement acts like a crucial link between the factory floor and the finished goods warehouse. Its primary purpose is to calculate the total manufacturing cost of all the goods that were fully completed during a specific accounting period. It tells you the cost value of everything that rolled off the assembly line and became ready for sale during that period.
Okay, and what goes into it?
It summarizes the three core product costs: direct materials used, direct labor incurred, and manufacturing overhead applied during the period. But it also adjusts for the change in partially completed goods, the work-in-process inventory. The calculation generally flows like this. You start with the value of your beginning work-in-process inventory, stuff partially done in the start of the period. Then you add all the manufacturing costs incurred during the current period, direct materials used, direct labor, and applied overhead. This gives you the total cost of goods that were available to be finished. Finally, you subtract the value of your ending work-in-process inventory, stuff still unfinished at the end. The result is the cost of goods manufactured.
Okay, let's try that with the XYZ company example for November.
Perfect. For XYZ Company, they start with beginning work-in-process inventory, $40,000. Then they add the manufacturing costs incurred in November. Direct material used, $30,000, plus direct labor, $50,000, plus manufacturing overhead applied, $40,000. That totals $120,000 in costs added during the month. Then they add the manufacturing costs incurred in November. So total manufacturing costs available: beginning WIP, $40,000, plus costs added, $120,000 to $160,000. Finally, they subtract the ending work-in-process inventory, what's left unfinished, $10,000. Finally, they subtract the ending work-in-process inventory, what's left unfinished. This leaves us with the cost of goods manufactured, COGM, $160,000, $10,000, $150,000.
So $150,000 worth of goods were completed in November. What's fascinating here is how that WIP inventory acts as a bridge, making sure only the cost of completed goods moves forward.
Exactly right. It's the holding tank that ensures the timing is correct.
Okay, so once those goods are manufactured, COGM, they usually land in finished goods inventory, right?
Yeah.
Sitting there waiting to be sold. How do we track the cost from that point until they actually get sold to a customer?
That brings us to the cost of goods sold, COGS, statement for a manufacturer. Conceptually, it's very similar to how a retailer calculates COGS, but with one key difference. Instead of adding purchases of inventory, the manufacturer adds the cost of goods manufactured figure that we just calculated. It's the final step connecting factory output to the income statement.
Okay, let's continue with XYZ Company's HES for November.
Right. The COGS calculation typically looks like this. You start with beginning finished goods inventory, $20,000. These were completed before November, but hadn't been sold yet. To this, you add the cost of goods manufactured for the current period, November, $150,000. This flows directly from the COGM statement. This gives you the cost of goods available for sale. $20,000 plus $150,000 equals $170,000. This represents the total cost of all finished goods that could have been sold during November. Finally, you subtract the ending finished goods inventory, what's completed but still unsold at the end of November, $50,000. Finally, you subtract the ending finished goods inventory, what's completed but still unsold at the end of November. The result is the cost of goods sold, COGS, for November equals $170,000.
Yeah.
$50,000, $120,000.
Got it. So $120,000 is the cost that hits the income statement for the product sold in November. If we connect this to the bigger picture, these two statements, COGM and COGS, are absolutely essential for figuring out a manufacturer's gross profit and overall profitability, right?
Absolutely. They are the financial scorecard for the entire manufacturing operation, translating factory activity into the numbers that determine the bottom line. Essential for both internal management and external reporting. #, beyond the basics, advanced cost allocation methods.
We touched on traditional overhead allocation earlier, that single plant-wide rate, often based on direct labor hours or machine hours. But what happens if that approach, that sort of broad brush, isn't really giving you an accurate picture? What if some products, even with similar labor hours, are just way more complex and consume a lot more support resources?
That's precisely the problem that activity-based costing, or ABC, was designed to solve. Traditional systems, as you said, often rely on those simple volume-based drivers. This can really distort product costs, especially in modern manufacturing environments with diverse products and complex processes. ABC works from a fundamentally different philosophy.
Okay, what's the core idea?
The core idea of ABC is that activities consume resources and products consume activities. So instead of assuming costs are driven just by volume, like labor hours, ABC asserts that costs are driven by the specific activities required to produce, support, and deliver a product. It's a much more granular and ultimately more accurate way to allocate those indirect overhead costs.
So it moves beyond just volume.
Exactly. Think about the difference between a volume-based driver, like direct labor hours, and an activity-based driver. The volume driver is simple, easy, but potentially misleading. It might assign the same overhead costs per labor hour to a simple product that runs smoothly and a complex product that requires constant machine setups, numerous quality inspections, and frequent engineering support.
Right. Even if they take the same labor time, the complex one clearly used more overhead resources.
Precisely. ABC tries to capture that. It identifies the key activities happening in the overhead areas, like setting up machines, inspecting products, processing purchase orders, redesigning components. Then it finds cost drivers that measure the frequency or intensity of those activities, like number of setups, number of inspections, number of purchase orders, number of engineering change orders.
Okay.
It assigns costs based on how much each product demands those specific resource-consuming activities. Instead of one big overhead pool, ABC uses multiple smaller cost pools, each linked to a specific activity. It focuses on the multiple causes, activities, and their effects, costs. The cost of the product is then built up by summing the costs of all the activities it triggered. Why does this give a more accurate picture? Because it directly links costs to the specific actions that cause them, rather than relying on a potentially unrelated volume average.
That makes conceptual sense. There must be some specific terminology associated with ABC.
Yes, definitely. Let's clarify a few key terms. An activity is basically any work performed inside the company that you identify for costing purposes. Could be anything from processing an order to setting up a machine. A resource is an element needed to perform an activity. Could be labor time, machine time, materials, electricity. Cost drivers in ABC are those activity measures that have a strong correlation with the costs in an activity center. They're used as the allocation basis. Remember that key idea. A factor that changes the total cost. Cost drivers in ABC are those activity measures that have a strong correlation with the costs in an activity center. They're used as the allocation basis. Remember that key idea. An activity center is a specific part of the operation where key activity takes place, like the quality inspection department or the material handling department. Cost drivers in ABC are those activity measures that had a strong correlation with the costs in an activity center. They're used as the allocation basis. Remember that key idea. A cost pool is just a grouping of costs associated with a single activity center or activity. Instead of one big overhead pool, you might have pools for setup costs, inspection costs, etc.
Can you illustrate that with an example? Maybe the Hope Hospital one.
Sure. Imagine Hope Hospital uses ABC for its surgical unit. The surgical unit itself could be an activity center. The resources consumed would be things like surgeon's time, nurse's time, operating room usage, sterile supplies.
Yeah.
A resource driver might be surgical complexity. A complex surgery uses more resources. Activities could include patient admissions, scheduling surgeries, preparing the operating room. The cost drivers for these activities might be number of admissions, number of surgeries scheduled, number of OR preparations. You'd create cost pools for each of these activities. It's all about breaking down the overhead into meaningful activities and drivers.
Okay, that helps clarify the terms. So how does a company actually implement ABC? What's the practical process?
It's a systematic process, generally involving about 6 key steps. 1. Identify cost drivers. First, you really dig into your operations to identify the significant activities that consume overhead resources and figure out what actually drives the costs of those activities. 2. Accumulate costs in cost pools. Instead of that single overhead pool, you create multiple smaller cost pools, one for each key activity you identified. Example, setup pool, inspection pool, material handling pool. 3. Trace indirect costs. Assign any indirect costs that can be directly traced to a specific activity center right away. 4. Allocate remaining indirect costs. For the costs that still need allocation, like factory rent shared by multiple activity centers, you allocate them to the appropriate activity cost pools using suitable drivers. 5. Calculate activity rates. Now, for each activity cost pool, you calculate an application rate. This is the total cost in the pool divided by the total estimated level of the activity driver. For each total setup cost, total estimated setup hours, rate per setup hour. You get multiple rates, one for each activity. 6. Cost of product. Finally, to get the overhead cost for a specific product, you track how much of each activity that product consumed. Example, how many setups it required, how many inspections it underwent, and multiply that by the respective activity rate. Summing of these costs across all activities gives you the total ABC overhead cost for that product.
That definitely sounds more involved than the traditional method. So what's the big payoff? Why go through all this extra work?
The significant payoff is a drastic reduction in cost distortion. ABC does a much better job of assigning high overhead costs to the products that are truly complex and resource intensive, and assigning lower overhead costs to simpler products that place fewer demands on resources.
Okay.
It corrects those situations where traditional systems, by using broad volume averages, might make a complex, low-volume product look artificially cheap, while making a simple, high-volume product look artificially expensive. ABC gives managers a much truer picture of individual product profitability.
Let's make that concrete with the Iowa products example. This seems like a perfect illustration. Remind us of the setup.
Right. Iowa Products makes two products, cans and bottles. Their traditional system used direct labor hours to allocate a total overhead budget of $3,120,000. Cans used 150,000 direct labor hours, producing 500,000 cans, and bottles used 45,000 direct labor hours, producing 150,000 bottles. Total direct labor hours were 195,000.
Okay. So under the traditional system, what was the overhead cost per unit?
Under the traditional system, first calculate the single plant-wide rate, $3,120,000 total overhead, 195,000 total direct labor hours equals $16 per direct labor hour. Then apply this rate for cans. 150,000 hours, 16 hours equals $2,400,000 total overhead. Divided by 500,000 cans, that's $4.80 per can. For bottles, 45,000 hours, 16 hours equals $720,000 total overhead. Divided by 150,000 bottles, that's also $4.80 per bottle.
Right. That's the key point. Traditional costing assigned the exact same $4.80 per unit overhead cost to both products, just based on labor hours.
Exactly. Now, let's see what happens with activity-based costing. Iowa Products dug deeper and identified 4 key activities driving their overhead costs. 1. Material handling. Total cost pool $480,000. Driven by pounds of material handled. Total 160,000 pounds. Rate equals $480,000. Well, 160,000 pounds equals $3 per pound. 2. Production orders. Total pool $90,000. Driven by the number of production orders processed. Total 200 orders. Rate equals $90,000. 200 orders equals $450 per order. 3. Product redesign. Total pool $250,000. Driven by the number of engineering design changes. Total 250 changes. Rate equals $250,000. 250 changes equals $1,000 per change. 4. Plant utilities. Total pool $2,300,000. Driven by machine hours. Total 230,000 hours. Rate equals $2,300,000. 230,000 hours. Now, you track how much of each activity each product actually used. Let's do cans, 500,000 units. Material handling. Used 100,000 pounds, 3 pounds, pours $300,000. Production orders. Required 100 orders, 450 order, weight equals $45,000. Product redesign. Needed 50 changes, $1,000 change equals $50,000. Plant utilities. Consumed 150,000 machine hours, 10 hours with $1,500,000. Plant utilities. Total ABC overhead for cans equals $300 plus $45K plus $50 tablet plus dollar pound cans equals $1,895,000. Plant utilities. Overhead per can equals $1,895,000 down to $3.79. Now for the bottles, 150,000 units.
Applying ABC rates to bottles.
They're doing.
Material handling. Use 60,000 pounds, 3 pounds, $180,000. Production orders. Also required 100 orders, 450 orders worth $45,000. Product redesign. Needed a whopping 200 changes. All $1,000 change was $200,000. Plant utilities. Consumed 80,000 machine hours, 10 hour equals $800,000. Plant utilities. Total ABC overhead for bottles equals $180K plus $45K plus $210 plus $800K, $1,225,000. Plant utilities. Overhead per bottle were $1,225,000, way up to over $8.16 per bottle.
That's a massive difference. Bottles went from $4.80 under traditional costing way up to over $8.16 with ABC. Exactly. And why? It wasn't because bottles used vastly more labor or machine hours relative to cans, which were the traditional drivers. It was because bottles required a huge amount of the expensive product redesign activity. 200 changes for only 150K units compared to cans. Only 50 changes for 500K units. ABC captured this non-volume related cost driver, revealing that bottles were actually much more expensive from an overhead perspective.
So the crucial takeaway is that ABC gave a much truer picture. It showed that the complex, frequently redesigned bottles were being subsidized by the simple cans under the old system.
Precisely. What's fascinating here is how ABC empowers managers with better information. They might rethink pricing strategies, maybe focus sales efforts differently, or look for ways to reduce the redesign activity for bottles now that they understand its true cost impact. It uncovers those hidden cross-subsidies.
Okay, ABC clearly offers more precision for manufacturing overhead. But what about those internal service departments like IT, human resources, building maintenance that support the whole company, not just production? How do their costs get fairly allocated to the operating departments?
That's another critical allocation challenge. These service department costs are real costs of doing business, and they ultimately need to be assigned to the final products or services that benefit from them. The general idea is to allocate these support costs to the production or user departments they serve, recognizing them as necessary inputs. There are a couple of common methods to do this.
What's the simplest approach?
The simplest and most widely used is the direct method. As the name implies, it allocates each service department's total costs directly to the production or other operating departments. The key feature and limitation of the direct method is that it completely ignores any services provided between service departments.
Okay, so IT costs go straight to production division A and B, HR costs go straight to A and B, but it ignores the fact that IT might provide services to HR.
Exactly. Let's use the Remington Company example. They have two production divisions, A and B, and two service departments. Information Systems, IS, costing $2,220,000, and Human Resources, HR, costing $975,000. IS uses computing hours as its driver. A uses 9K, B uses 6K. HR uses performance appraisals. A needs 2.8K, B needs 2.2K. Using the direct method. First, find the allocation basis only considering the production divisions. IS total hours, 9K plus 6K plus 15,000. HR total appraisals equals 2.8K plus 2.2K equals 5,000. Calculate the rates. Calculate the rates. IS rate equal $2,220,000. $15,000 equals $148,000 per hour. Calculate the rates. HR rate equals $975,000. $5,000 appraisals equal 195 APE for appraisal. Now allocate to Division A from IS 9,000 hours, 142,000 up, $1,332,000. From HR total $48, $1,872,000. From HR 2,200 appraisals, 122,000 equals $848,000. From HR 2,200 appraisals, 195 AP, $188,000 plus $428,000 plus $428,000. Okay, that's straightforward. But does it feel like it might miss something if the service departments rely heavily on each other? Is there a method that accounts for that? Yes. That's where the step-down method, also called the sequential method, comes in. It's a bit more sophisticated because it does recognize services provided between service departments, but it does so in a specific sequence.
Okay, how does that work?
You first allocate the costs of one service department to all other departments that use its services, including other service departments and production departments. Then you take the next service department, including any costs it just received from the first one, and allocate its costs to the remaining departments. The key assumption is that once a service department's costs are allocated or stepped down, no costs are allocated back to it later in the sequence.
So the order matters.
The order definitely matters. Usually you start by allocating the cost of the service department that provides the highest percentage of its services to other service departments, or perhaps the one with the largest total costs. Let's redo Remington. But this time, let's say HR also does 200 appraisals for the IS department itself. We'll allocate HR first, assuming it provides broader service, then IS. Step 1. Allocate HR costs to IS, Div A, Div B. HR's total service base now includes IS, 2,800A plus 2,200B plus 200 IS of 5,200 total appraisals. HR's total service base now includes IS. New HR rate equals $975,000, 5,200 appraisals, $187.50 per appraisal. Allocate HR to IS. 200 appraisals, $187.50. Allocate HR to Div A. 2,800 appraisals, $37.550. $487.550. $37.50 test plus 525 Hays plus 425K equals 975K. HR is fully allocated. Okay, so IS gets a chunk of HR costs now. Then what?
Step 2. Allocate IS costs, original IS costs, plus allocated HR cost. IS's total cost to allocate original $2,220,000 plus $37,500 from HR equals $2,257,500. IS allocation base to production divisions remains 15,000 hours, 9K for A, 6K for B. We don't allocate back to HR. New IS rate, 2,257,550 hours. Allocate IS to DeVay on 500. 9,000 hours, $150.50. $150.50 was $1,354,500. Allocate IS to Div B. 6,000 hours, $150.50, or is $903,000.
1.3545 memo plus 1,354,500 memos, 2.2575 ammers. IS is fully allocated.
For Division A, it received $425,000 from HR plus $1,354,500 from IS equals $1,815,500.
Interesting. Comparing that to the direct method, 1.878 ammer for A, 1.31 sin for B, the numbers shifted slightly. Division A gets slightly more cost, Division B slightly less under step down in this case. Exactly. Because some of HR's cost went to IS first, less of HR's cost went directly to A and B compared to the direct method. But then IS had more cost to allocate out. What's fascinating is how this seemingly technical choice of allocation method can subtly change the reported costs and therefore the perceived profitability of different parts of the business, influencing internal decisions. The step-down is generally seen as more accurate than direct, though even more complex methods exist, like the reciprocal method, which handles mutual services simultaneously using algebra, #tag untangling complexity joint products and byproducts.
Okay, let's tackle one more really interesting area of complexity, joint products. Imagine a process where you start with one raw material, like crude oil, and out the other end come multiple different valuable products, gasoline, diesel fuel, kerosene, etc. How on earth do you assign the initial cost of the crude oil and the refining process to each of those distinct end products?
That is a classic and often quite tricky cost accounting problem. You've hit on the core challenge. Allocating the cost of a single shared process, those joint costs, among several different final products when two or more valuable outputs emerge simultaneously from the same input. The difficulty arises because those joint costs are incurred before the point where the individual products actually become separately identifiable.
Right. You can't tell which cost belongs to gasoline versus diesel while it's all still just crude oil being heated.
Precisely. The meatpacking industry example you mentioned earlier is perfect too. You start with one input, a steer. That single input and the initial processing yield various distinct outputs. Different cuts of meat like steaks and roasts, which are joint products. Maybe some lower value items like materials for pet food or glue, which might be byproducts. Each of these needs to have some cost assigned to it, even though they all came from that common starting point and initial shared costs.
Okay, to navigate this, I bet there's some specific terminology we need to get straight first.
Absolutely. Getting the terms right is crucial here. Joint products. These are two or more products generated from a common input or process, where each product has a relatively significant sales value. They are considered main outputs of the process. Gasoline and diesel fuel from crude oil are typically joint products. Byproducts. These are outputs that also come from the same process, but have a relatively minor sales value compared to the joint products. They're considered incidental or secondary results of producing the main products. Think sawdust from lumber milling, or maybe fruit peels from a juice factory. Split-off point. This is the critical stage in the production process where the joint products and byproducts become separately identifiable from each other. Before this point, costs are joint. After this point, costs can be traced to individual products. Joint costs, or joint product costs. These are all the manufacturing costs incurred up to the split-off point. This includes the initial raw material cost and any shared processing costs before the products become distinct. Separable costs. These are any costs incurred after the split-off point that are specific to an individual product. If gasoline needs further refining after the initial split from other fractions, the cost of that additional refining is a separable cost, traceable only to gasoline.
Okay, that clarifies the landscape. So the big question remains, once you hit that split-off point and you have your distinct joint products like gasoline and diesel, how do companies actually divide those shared joint costs that were incurred before the split-off?
There are several common methods used to allocate those joint costs.
Yeah.
One of the simpler ones is based on allocation by unit volume relationships, sometimes called the physical units method.
Okay, sounds like it uses quantity.
Exactly. This method allocates the total joint costs based purely on the physical measure, like gallons, pounds, board feet, number of units, of each joint product produced at the split-off point. Let's take Simple Manufacturing Company. They incur $10,000 in joint costs to produce product A and product B. At split-off, they get 10,000 gallons of product A and 20,000 gallons of product B. Total volume is 30,000 gallons. Allocate to product A, 10,000 gal, 30,000 total gal, $10,000 joint costs equals $3,333. Allocate to product B, 20,000 gal, 30,000 total gal, $10,000 joint costs equals $6,667 cost. Allocate to product B. The final cost of each product would then include any separable costs incurred after split-off plus this allocated joint cost. It's simple, but the big drawback is it ignores the potential economic value differences between the products. A gallon of premium gasoline might be worth much more than a gallon of industrial solvent, but this method might allocate them similar costs if volumes are similar.
Right, that doesn't seem very economically rational if the prices are way different. What's a more common approach?
A more common and generally preferred method uses the relative net realizable values, NRV, of the products at the split-off point. Net realizable value, remember, is the estimated final selling price of a product minus any costs required to complete and sell it after the split-off point, those separable costs. This method tries to allocate joint costs in proportion to the product's expected profitability or revenue-generating ability. It's primarily used for inventory valuation and internal analysis.
Okay, using NRV, how does that work in practice? Are there different scenarios?
Yes, there are two main scenarios depending on whether you know the market value at the split-off point.
Sales price quotations are available at split-off. If there's a market for the joint products right at the moment they become separate, even if you plan to process them further, you can use those market prices to allocate joint costs.
Consider Brown Company with $1,000 in joint costs. At split-off, they have 100 units of product A with a market price of 20 unit and 400 units of product B with a market price of $15. Calculate total market value at split-off. A equals 120, 2,000. B equals 415, equals $6,000. Total equals $8,000. Allocate joint cost based on this value to A, $2,000, $8,000, $1,000, $250. To B, $6,000, $8,000, $1,000, $750. To B, this allocates more joint cost to product B because it has a higher total market value at the point they separate.
Okay, that makes sense if you know the price right then. But what if there isn't a market at split-off? What if they have to be processed further before they can be sold?
That's scenario 2. Sales value is not available at split-off. In this case, you have to estimate the hypothetical sales value at split-off. You do this by taking the product's final selling price after further processing and subtracting the separable costs incurred after the split-off point to get it ready for sale. This result is the net realizable value, NRV, which serves as your proxy for the value at split-off. Let's use Smith Company. They have $30,000 in joint costs making products F and G. Neither can be sold at split-off. Product F needs $16,000 more in separable costs, then sells for 1,600 units produced. Product G needs $24,000 more in separable costs, then sells for 800 units produced. First, calculate the NRV for each. NRV of S, final sales value, separable costs, 25,000, 1,600 units, $16,000, 40,000, $16,000, $24,000, $40,000, $16,000. NRV of G, final sales value, separable costs, 5,800 units, $24,000, $40,000, $24,000, $16,000. Total NRV for allocation, $24,000 F plus $16,000 G.
Right, 40,000 G.
Okay, so you worked backward to get the value before the extra costs. Now allocate the $30K joint cost.
Exactly. Allocate the $30,000 joint cost based on these relative NRVs. Joint cost to F, $24,000, $40,000. $30,000, $18,000. Joint cost to G, $16,000, $40,000. $30,000, $12,000. Joint cost to G. What's really neat here is that even without a direct market price at split-off, you can still use this NRV method to get a reasonably logical value-based allocation of those shared joint costs. And yes, service department costs can also be allocated down to joint products, often using the unit volume method if NRV isn't practical for those costs.
Okay, that covers the main joint products. What about those minor outputs, the byproducts? How are they handled? They seem less significant.
They are, by definition, less significant in value. Byproducts are those outputs with relatively minor sales value that emerge incidentally from the process of making the main joint products. Think back to the meat packing, maybe the hides or certain bones are byproducts compared to the prime cuts of meat. Their value isn't considered substantial enough to justify allocating a share of the joint costs to them in the same way as joint products.
So no joint cost allocation to byproducts. How is their revenue treated then?
Generally, there are two main ways to account for the revenue you get from selling byproducts. 1. Applied to main product costs. The proceeds from selling the byproduct are treated as a reduction of the joint costs that are allocated to the main products. So if you sell $500 worth of sawdust, a byproduct of lumber, you might credit that $500 against the joint costs of producing the lumber, effectively lowering the cost assigned to the main product. This can be done when the byproduct is produced or when it's sold. 2. Miscellaneous income. Alternatively, the revenue from selling the byproduct is simply treated as other income or miscellaneous revenue on the income statement. It's kept separate from the main product costing and cost of goods sold calculation. This method highlights its incidental nature.
The choice between classifying something as a joint product versus a byproduct seems like it could change over time based on market conditions.
Oh, absolutely. It's often a practical business decision based on relative market demand and value. The gasoline example is perfect. A century ago, when crude oil was refined primarily for kerosene, for lamps, gasoline was often considered a useless, low-value scrap or, at best, a byproduct.
Right, before cars were common.
Exactly. Then, with the rise of the automobile, demand for gasoline soared. It transitioned from being a byproduct to being a major joint product, often the most valuable output from refining. This really underscores how market forces can completely change the economic significance and therefore the accounting classification of outputs from the same physical process. It's not just a static accounting rule. It reflects real-world economics. Hashtag outro.
So after diving deep into all these concepts, cost objects, product versus period costs, direct versus indirect, fixed versus variable, job order versus process, ABC, joint costs, byproducts, what does this all really mean for you, our listener? Whether you're looking at company financials, maybe running your own venture, or just curious about how the business world ticks.
Well, I think the big takeaway is that cost accounting isn't just some, back office bean counting exercise.
Yeah.
It's truly the backbone of operational efficiency, smart pricing, and sound strategic decision making. We've seen how defining what you're costing, tracing expenses, understanding cost behavior, and applying the right allocation methods, whether simple or sophisticated like ABC, all feed into getting a much clearer, more accurate picture of profitability and where resources are really going.
Right.
You now have, hopefully, a much deeper insight into that whole journey businesses take transforming raw inputs into valuable outputs and needing to understand every single cost, both the obvious and the hidden, along that entire path.
Yeah, definitely a clearer picture. Okay, here's a final thought to leave you with.
What?
Next time you pick up any product off a shelf, could be your phone, could be a carton of milk, anything, just pause for a second. Consider all those hidden layers of cost accounting that had to happen to arrive at the price tag you see. Think about the materials, the labor, sure, but also the supervisor's salary, the factory's electricity bill, the depreciation on the machines, maybe even a portion of the HR department's budget that supported the factory workers. How do you think companies ultimately decide which slice of all those diverse costs truly belongs to that specific item in your hand?
It's a fascinating puzzle.
It really is. It's complex, it's dynamic, but getting it right is absolutely essential for any business that wants to thrive. All right, that's our deep dive for today. Until next time, keep that curiosity alive.